From the Medici banks of Florence to the skyscrapers of modern Wall Street, investment banking has quietly shaped the course of human history for centuries. Wars were funded, empires expanded, and fortunes were created or destroyed not with armies or crowns, but with ledgers, contracts, and decisions made in dimly lit rooms by a handful of financiers. This is the hidden story of how money became power, and how investment banking evolved from a local merchant practice into a global force controlling trillions of dollars today. Long before Wall Street or London's financial district existed, merchants in Italian city-states like Florence, Venice, and Genoa were laying the foundations of modern finance. These cities were not just cultural hubs, they were laboratories of credit, trade, and financial innovation. Families like the Medici mastered more than commerce. They mastered influence. By lending to kings, merchants, and even the Pope, they discovered a revolutionary truth. Money could wield more power than armies. The Medici could fund wars without sending a single soldier, support colonies without dispatching ships, and control monarchs simply by managing their debt. When European rulers needed cash for crusades or battles, they turned to the Medici Bank. And the Medici had a choice: fund them or withhold funding. In their hands, money became influence, as history would repeatedly show, often proved more decisive than any battlefield. By the 17th century, Venice and Florence had faded, and the center of financial innovation shifted north to Amsterdam. Here, investment banking began to resemble the system we recognize today. The Dutch East India Company, founded in 1602, issued the world's first publicly traded shares. Citizens could invest in a global trading empire, while governments borrowed huge sums to finance wars and infrastructure through bonds. From Amsterdam, this model spread to London, where the city became the financial heart of the British Empire. Banks underwrote trade, financed colonial expansion, and sold massive government bonds to fund wars against Napoleon and beyond. One figure in particular, Nathan Meyer Rothschild, demonstrated the true power of capital. He did not fight Napoleon with cannoncy, fought him with money, speed, and information. By moving funds across Europe faster than any government could track, Rothschild influenced markets, funded armies, and became wealthier than kings. His story revealed the immense leverage of capital and intelligence over armies and politics. But the power of investment banking has always been fragile. Time and again, financial systems collapsed when trust evaporated. The South Sea Bubble of 1720 in London showed how speculation, greed, and misinformation could destroy fortunes overnight. Later, in the United States, the Panic of 1907 demonstrated that even the largest banks could fail without a central system to back them. These crises directly led to the creation of the Federal Reserve in 1913, laying the foundation for modern investment banking regulation. During the 20th century, banks like J.P. Morgan, Goldman Sachs, and Lehman Brothers became critical players in global finance. They raised capital for governments and corporations, underwrote infrastructure projects, and managed crises. Yet, every major crisis from 1929 to 1987, and again in 2000, revealed the same lesson. Investment banking could generate immense wealth, but it could also create systemic risk capable of toppling economies. After the 1929 crash, the U.S. implemented the Glass-Steagall Act, separating commercial and investment banking for decades. Excessive risk system remained constrained. But by the 1980s and 1990s, financial innovation allowed banks to circumvent these regulations. Complex derivatives, leveraged buyouts, and off-balance sheet vehicles enabled enormous risk accumulation, setting the stage for the 2008 financial crisis. Lehman Brothers, once a titan, collapsed. Governments had to step in to bail out institutions deemed too big to fail. History had repeated itself. Unchecked innovation without oversight leads to booms, crashes, and social fallout. Today, investment banking is a global network controlling trillions of dollars. The top 10 banks manage over $15 trillion in assets. Global derivatives exceed $600 trillion, many times larger than the world's GDP. Some banks' balance sheets are 10 to 20 times the size of entire national economies. Despite technological and regulatory evolution, the patterns remain unchanged. Leverage amplifies gains, innovation drives expansion, and greed, combined with poor oversight, seeds the next crisis. From Florence to Wall Street. The history of investment banking teaches three essential lessons. First, trust is the ultimate currency. Without it, even the largest banks collapse. Second, power is often invisible. Financiers often wield more influence than politicians or generals. And third, innovation is double-edged. Every financial breakthrough creates both opportunity and systemic risk. As we examine today's financial system, the warning is clear. History is not linear. Bubbles burst. Confidence. Erodes. Systems that seem permanent are fragile. The question is not whether another financial crisis will occur, it is when and who will control capital when it does. Understanding the evolution of investment banking is not optional. It is essential. Money is not just currency, it is power, influence, and history itself, even beyond wars, empires, and crises. Investment banking has quietly influenced almost every major technological and industrial revolution. Banks provided the capital that built railways, canals, and telegraph networks, enabling global trade to expand at unprecedented speeds. They financed the Industrial Revolution in Europe, allowing factories to grow, machinery to be purchased, and labor to be mobilized on a scale never seen before. Investment bankers were the invisible architects of modern economies, connecting savers in one part of the world to entrepreneurs and governments in another. Yet, the role of investment banking has never been purely neutral or benevolent. Behind the spreadsheets and bond issuances, bankers often held enormous political sway. In some cases, entire countries' policies were shaped by the flow of capital rather than the will of citizens. Loans were sometimes given not to support growth, but to control, to influence, or to extract advantage from weaker nations of financial subtlety that few fully understood. Over the centuries, investment banking evolved from small merchant houses to global institutions. Early families, like the Medici and Fuggers, expanded beyond local markets, pioneering letters of credit, bills of exchange, and early forms of risk management. These innovations laid the groundwork for modern derivatives, structured finance, and the complex investment vehicles we see today. The 19th and 20th centuries saw new forms of investment banking emerge in America, with firms like J.P. Morgan consolidating industries, orchestrating mergers, and underwriting massive government debt. These banks acted as both financiers and advisors, bridging private wealth and public projects, while simultaneously creating concentrated centers of economic power. Modern investment banking is more complex than ever. Algorithms now execute trades faster than humans can process information. Derivatives and securitized products move trillions of dollars daily, and global capital flows in ways impossible to track entirely. Shadow banking, high-frequency trading, and private equity have extended the power of finance into realms previously unimaginable, with enormous rewards but equally immense systemic risk. Investment banking also shapes innovation in ways often unseen. Venture capital, an offshoot of traditional investment banking, has funded the technology companies that now dominate our daily lives, from Silicon Valley startups to global social media platforms, the very tools of modern society's smartphones. AI. Renewable energy projects have roots in the capital structures and risk appetite created by investment banks. Yet, history repeatedly reminds us that this power is deep. While bankers can accelerate growth, they can also amplify inequality, create bubbles, and trigger crises. The repeated pattern is clear. Financial innovation without oversight creates both extraordinary opportunity and profound danger. As we look forward, understanding investment banking is no longer just for financiers or historians. It is a lens through which we can interpret global power, wealth, distribution, and even the stability of entire nations. From funding the first global trading empires to underwriting the tech giants of today, investment banks have left their fingerprints on every epoch of economic progress. In essence, the story of investment banking is the story of human ambition, a combination of ingenuity, risk, influence, and, at times, hubris. It is a reminder that behind every major transformation in society, behind the railways, skyscrapers, and tech giants, there was often a financial architect, quietly shaping the future. Understanding this history equips us to recognize patterns, anticipate risks, and appreciate the invisible forces that have molded the modern world. Investment banking is not just a financial system, it is a reflection of human creativity, ambition, and, sometimes, greed. And as long as capital continues to flow, investment banks will remain at the center of every revolution, crisis, and breakthrough yet to come. The hidden history of investment banking is not just a story of money, it's a story of human progress, influence, and the delicate balance between risk and reward. If this video helped you uncover the hidden story behind money, power, and history, subscribe for more deep dives into financial history. Hit the like button if you want to explore how finances shape the world, and leave a comment below. Which era of investment banking fascinates you most? The Medici, the Rothschilds, or modern Wall Street? History has lessons. Finance is the teacher, and the story is far from over.